What's up, everybody? Joe Brown here. This is the Heresy Financial Show. Today we are going to be looking at the Federal Reserve's balance sheet because they are starting to tighten. We have started to see that balance sheet tip over, start to move down, and it will accelerate next month, and this could cause major problems in the plumbing of the financial system. So we're going to look at why. Ready? Let's dive in. All right, take a look with me at the Federal Reserve's balance sheet right here. We can see this is their total balance sheet since 2003 up until now. We can see what they did during the financial crisis. Every time they tried to wind this thing down, didn't work. They had to ramp it back up again. And then this period right here from 2014 through 2017, that was the longest period of just kind of moving sideways. And then on the backs of the Tax Cuts and Jobs Act, knowing that that was going to get passed, they were looking at this and saying, hey, we've got room to actually tighten here. What is going on here? I will explain this more in detail, but we've got a relationship between money available in the system and then withdrawing money out of that system. So if we look back at this chart here, they were starting to withdraw money out of the financial system by selling assets off of their balance sheet here because there was a little bit of extra money freed up in the economy through the Tax Cuts and Jobs Act there. Well, obviously that failed in September 2019 when the repo market blew up and they resumed not QE at this point and started blowing up their balance sheet yet again, and then COVID hit, and the rest is history there. If we take a look closer in here, we can see the balance sheet has started to tip over and it has turned the corner here. Zoom out a little bit, we can see that it is starting to head downwards here. Now, one note about this is that starting next month, they are going to get much more aggressive with how fast they are selling assets off of this balance sheet, probably to the tune somewhere around $90 billion per month. So right now, it's still kind of moving sideways as just one of the down weeks. And you can see if we hit that edit graph button, we'll come over here and we can change this to see the weekly change. And so we can see here, if we zoom in, the amount that it has dipped down recently this last week is not really that different compared to the regularly scheduled down weeks on their balance sheet. We can see throughout this entire time they've had up weeks, sideways weeks, down weeks. That's just part of their regular cycle of their change here. So their down weeks here are regularly somewhere around this $30 billion mark here. So this dropping $31 billion is not that different. But what you can see is the peaks started to decline here. Right around here, those peaks started to decline, and really in the beginning of 2022 started to decline. So this was when they were tapering their purchases. I was saying for a long time, hey, the Fed's actually tapering their purchases. And many people were saying, no, you're crazy. They'll never actually taper. And it turns out they are tapering, and they just didn't care about what that would do to asset prices. And so they started reducing the amount they were purchasing, and now they are moving into where you will see now it stays below this black line weeks and weeks on end. They might have certain up weeks, but for the most part, this will be moving down. They're going to have over month net subtractions from their balance sheet. So let's take a step back and explain why this withdraws money from the financial system. The Federal Reserve's balance sheet is full of treasuries and mortgage-backed securities. The way that it got that way is because they typed in some buttons on a keyboard, gave themselves money, and credited that cash, those dollars, to somebody else's account, a financial institution, a bank, and in return, what they got for it was an asset like a treasury or a mortgage-backed security. So they created money out of thin air, out of nothing, and then used that money to go buy a debt instrument, a treasury or a mortgage-backed security. They did that to the tune of sitting at right now right around $9 trillion. And so they've created $9 trillion out of thin air, injected that into the financial system through the purchasing of treasuries and mortgage-backed securities. That means when their balance sheet declines, the exact opposite is happening. They're taking those assets that are on their balance sheet and they are selling them into the open market. So So they're taking a treasury, they're taking a mortgage-backed security, and they are selling them to somebody. And this is an open market. It's like the stock market kind of thing. It's just an open market. And so they're constantly buyers and sellers of these things going back and forth all day long. And so they're just adding to the selling pressure. So some of the assets they're selling are getting bought by Chase or Wells Fargo or other financial institutions. What that means is that money is leaving the financial system, because just as money entered the financial system from the Fed creating that money and buying an asset with it, money is going to leave the financial system by them taking an asset, selling it, and getting money, dollars, in exchange for that. Well, that money just gets destroyed. It just ceases to exist, because the Federal Reserve it's where it comes from. It pops up into existence and then pops out of existence. And so this is where money starts to leave the financial system and ceases to be in circulation. So that is why quantitative tightening, selling assets off their balance sheet, will reduce the money supply, all else being equal. It has a reductive force on the monetary supply. Now, obviously, banks can loan money into existence as well, so I'm not making the claim that this will have a direct impact on, let's say, M2, on the exact money supply, because the Federal Reserve is not the only one who can create money out of thin air. Banks can do that too. All else being equal, this would reduce dollar for dollar the supply of dollars that are in circulation. Okay, so knowing that, why does that contribute to a decline in asset prices? Well, number one, right off the bat, you've got the selling pressure, right? All else being equal, buyers and sellers find equilibrium, an equilibrium price, where all the buyers and all the sellers and all the potential buyers and all the potential sellers are auctioning back and forth, coming up with a consensus equilibrium price at any given moment. And so all else being equal, if you add more selling, more sellers into that equation, then that would push that equilibrium point down to the price that is lower. The question is, well, that would only impact the assets that the Federal Reserve is actually selling then. So why in the world is this causing, for instance, stocks to fall? Well, it goes back to the fact that the total monetary supply is decreasing, or decreasing relative to what it would be otherwise. Because if we have a constant money supply, let's say it's 100% fixed, then the price movements of anything are really pure signal on the aggregate subjective values of every economic actor. That's all. It's just a signal about what people want more than other things. But on net, when you start to see prices drop across the board, well, that's reflecting a lower monetary supply, because you have less money, which means the money is more valuable relative to all the stuff. If you think about supply and demand, if you take away some of the money, then there is less money in circulation. That means it takes less money to bid for things, goods, services, assets. It's the exact opposite of inflation, when if you say double everybody's money, then everybody has more buying power, more demand power. They go out and start to buy with that extra money. It bids up the prices of goods and services and assets. And basically what you're doing is increasing the quantity of money, increasing the quantity of what you are using to measure the wealth. And so just as inflation causes prices to go up because the total supply of money increases faster than the total supply of wealth in which it is measuring, so a decrease in the supply of money will make that money more scarce relative to all the stuff, meaning it is more valuable than all the stuff, meaning all the stuff is cheaper compared to the money, meaning the prices go down measured in that money. Now, at this point, you're probably saying, but Joe, it's hypocritical of you to say this is a bad thing, because you're always talking about how deflation is what this world needs. Deflation is good, inflation is bad, and absolutely. So I'm not really scared about the deflation. I think if the Federal Reserve grows some balls here and actually sticks to QT, that would be a good thing. Wipe out the malinvestments, wipe out the bubbles, wipe out the moral hazard, wipe out the risk in the system, allow some bankruptcy to happen, and we can restart from a more solid foundation that's not built on high risk and high debt, but on savings, on sound financial principles moving forward. What scares me is the response, because they're not going to grow a pair. We're not going to go through with this. At the first moment of a fire, they will reverse course. Take a look with me at this article from Bloomberg. It's an opinion piece. It says the Federal Reserve's next act will test market stability, saying that the Federal Reserve's resolve to fight inflation will be tested, or could be tested, before a recession even hits because of how the financial plumbing works. In the article, this author goes through the last few decades of examples of every time tightening has caused some sort of crisis, whether small or large, in the financial plumbing. Let's say the repo market. That was a big example that I showed you on the Federal Reserve's balance sheet here in September of 2019. Let's zoom out. In September of 2019 here, they were engaging in tightening. It caused massive failure in the plumbing of the financial system, so the Federal Reserve had to reverse course. That's what they always do, and that is what this author is pointing out in this article. And in the conclusion of this article, he says, what is certain is that once the Fed starts shrinking its balance sheet while still raising rates, there will be an unprecedented scale of tightening. We're going to be getting higher rates, which is disinflationary or deflationary, and we are also going to be getting a tightening balance sheet, a declining balance sheet, and so the supply of money is getting sucked out of the system very quickly. And he's saying if the backbone of the financial system starts to crack, expect the Fed to alter its course, because that's what it always does. And so this is what I've been saying all along. Yes, the Federal Reserve is going to go through with tightening. They're raising rates. They're selling assets off their balance sheet. And if the only thing that happens is your brokerage account and your 401k and Aunt Sally's IRA starts to decline in price, they will do nothing. They don't care. What they do care about is the financial plumbing starting to break. One of the big boys is insolvent. Somebody can't get funding. One of the too big to fail corporations says, I need a bailout. At that moment, they will reverse course. It's not even just my opinion, that it's the opinion of mainstream economists and authors like of this Bloomberg article that we were just looking at. All it's going to take is something too big popping and breaking in the financial system. And in my opinion, that's probably going to happen by the end of this year, given the pace at which they're tightening and given the amount of risk that is pent up in the system and the speed at which things have already started to collapse when they haven't even really gotten started with tightening yet. As always, we will have to wait and see, but I will let you know as soon as I see anything crazy. Thank you for watching. You have a great day.